bring in Judy Shelton, senior fellow at the Independent Institute. She was once President Trump's nominee to the Federal Reserve Board for a while, Judy, and welcome. For a while, you've been talking about the notion that prosperity or a strong economy doesn't necessarily mean higher inflation if it's accompanied by productivity gains. And I don't know if you saw Kevin Warsh last week, but he talked for a while and made that same point. Did you see that interview, and did you agree with most of the things that he said, or where did you disagree?
Well, I agree with his call for monetary regime change. In fact, I was delighted to hear that because in April of 2019, I had the lead opinion piece in the Wall Street Journal, and the title was "The Case for Monetary Regime Change at the Fed." So I think that we're looking at something that goes way beyond whether the Federal Open Market Committee decides to lower interest rates a quarter of a point in July or waits until September. We're really looking at much deeper problems at the Federal Reserve, its models, its constructs, the way the Federal Reserve staff choreographs the meeting. I think we're missing a strategic approach. Our central bank has to be part of a whole of government approach for economic and national security reasons and making our country successful. So I welcome this comeuppance that the Federal Reserve is having. I think it's good to challenge them. I don't think it's the role of the Fed to stand there as being in judgment of the economic growth policies of an elected president.
Do you think, would you think it would be a very bad idea to make an early change before May for President Trump and Jay Powell?
Well, you know, what people invoke are the two things. One, would it be a violation of the sanctity of central bank independence, and would it roil financial markets? And that's usually enough to squelch the option of the Federal Reserve chairman being fired. I would say first that I think it violates the norms of democratic governance to have the head of a federal agency, an agency that is so powerful, so prominent in financial markets, and so political itself, who cannot be fired by anyone, by Congress, by the president, by anyone. So as far as the idea that Federal Reserve independence is sacrosanct, I would say this. When you invoke that, you're really absolving Congress of its constitutionally mandated responsibility for oversight on the regulation of money. And at the same time, you're insulating the Federal Reserve from criticism, legitimate criticism of its mechanisms, of its models by Congress or the president. And I think that is why the Fed is now in a position of such a mismanaged fiscal situation. It's been running at an operating loss since September of 2022. It has over $900 billion in unrealized capital losses in its own portfolio. And it's using a mechanism that's paying hundreds of billions of dollars to private commercial banks to effectively induce them to keep their money in cash reserve accounts at the Federal Reserve instead of lending it out, or at least investing it in Treasury securities that would help bring down the rates that really matter to the real economy, the 10-year, the rates that involve real Americans and their decisions about buying a house or gaining access to capital to expand their own small businesses.
Is that a bribe? I don't even, you've been talking about that for a long time. What's the rationale? And if you look at some of the big money center banks and how much of the profits over the last 5 years or what percentage, I mean, it's a minute thing, how much they've been able to generate by, I don't even know what it is. What's the rationale for that, for paying the commercial bank's interest?
It came about as a emergency measure. We're talking about October of 2008. So already to me, I don't know who should be blamed more than the Federal Reserve for the global financial meltdown that occurred at that time. And Bernanke was the chairman. In fact, I noticed in the Kevin Warsh interview, which I quite enjoyed, he referred to Ben Bernanke as kind of a hero because it was a time when Kevin Warsh admitted we were making it up as we went along. And part of that aspect of making it up was that the Fed was going to end up making large-scale purchases of government assets. We call it QE, because they were going to lower the interest rate to zero by purchasing treasuries. And Bernanke knew that when you do that, the way the Fed does that is they say to a bank, we'll buy your treasury security. And the way we do it is we just credited your cash balance account here at the Fed for $1 million with a keystroke. When you do that, you created what we call base money, what Milton Friedman called high-powered money, because we had reserve requirements in those days. And that meant banks could lend that money out. And the whole idea was you're going to generate a multiplier effect and have economic activity, and that's going to help rescue an economy that was flailing after the financial meltdown. And Bernanke wanted to be able, because he was accused by smart people, like Paul Ryan said, well, that will unleash hyperinflation. Bernanke later said on a 60-minute segment, we can raise interest rates in 15 minutes. This gave the Fed the ability not to have to engage in open market operations to address inflation the Paul Volcker way, but to simply, in a way more reminiscent of the old Soviet state-run banking system, to dictate the interest rate. And if you pay banks more to keep their money sitting risk-free at the Federal Reserve at a very hefty interest rate, that becomes a more lucrative use of their money than to make loans. It's hard work to engage in real financial intermediation. That's what they will do. And why this has perpetuated to this day, that's one of the reasons we need to open up the Fed and move to a different construct. I would eliminate the Fed's use of this tool of paying interest on reserves and go back to shrinking its portfolio if you want to raise interest rates.